The screen is flashing red. Your portfolio is down. The financial news headlines are screaming about crashes, corrections, and bear markets. For most people, this is a moment of pure panic. The instinct is to sell, to run for the hills, to protect what's left. But what if I told you that you're looking at this entire situation backwards? That for the disciplined, long-term investor, a market dip isn't a threat, it's the single greatest opportunity you'll get all year. It's the annual sale on Wall Street, where the assets you've always wanted to own suddenly go on a 10, 20, or even 50% discount. The problem is, most people are so consumed by fear that they either freeze up or make catastrophic mistakes. In this video, we're going to flip the script. We're not just going to tell you to buy the dip. We're going to give you a complete, actionable game plan. You'll learn the exact mental framework, the specific strategies, and the common pitfalls to avoid so that you can confidently navigate market downturns and use them to significantly accelerate your journey to financial freedom. Let's turn panic into progress. The very first thing you need to do, before you even think about buying a single stock, is to master the psychology of a downturn. This is the foundation everything else is built on. When the market falls, your brain is going to be hijacked by two powerful emotions, fear and greed, but they manifest in strange ways. The fear is obvious, the fear of losing more money. But the greed is more subtle. It's the desire to wait for the absolute bottom, to be the genius who buys at the very lowest tick. This is a trap. Trying to time the absolute bottom is a fool's errand. It's like trying to catch a falling knife. The goal isn't to buy at the bottom, the goal is to buy at a good price relative to the long-term value. The other psychological trap is what I call anchoring. You're emotionally anchored to the price you originally paid for a stock, or to the all-time high the market recently hit. Seeing a stock you own fall 30% feels like a failure. But you have to reframe that. For a new purchase, that 30% discount is a victory. You must learn to separate your ego from your portfolio. The market doesn't care what price you paid. It only cares about the value it's offering you today. So, rule number 1, see a market dip not as a loss on your screen, but as a discount at the store. You wouldn't panic if the television you wanted to buy went on sale. You'd be excited. Adopt the exact same mentality with stocks. Now, with the right mindset in place, you need a battle plan. You cannot be scrambling to figure out what to buy when everything is crashing. That's how you make impulsive, emotional decisions. The key is to prepare during the calm times. This is your most powerful weapon, a pre-made watch list. When the sun is shining and the market is hitting new highs, that is the time to do your research. Identify the high-quality companies you believe in for the long term, the ones with strong balance sheets, durable competitive advantages, and excellent leadership. These are the blue-chip stocks, the industry leaders, the foundational ETFs like the S&P 500. Add them to a specific watch list in your brokerage app. And here is the critical step: set target buy prices. Decide, rationally and calmly, at what price you would be absolutely thrilled to own a piece of that business. For example, if a great company is trading at $150 per share during a bull market, you might decide that a 20% drop to $120 is a fantastic entry point. A 30% drop to $105 is an absolute steal. By doing this work in advance, you remove all emotion when the dip happens. You don't have to wonder, is this a good price? You already have your answer. When the market panic hits and your watch list starts hitting those predetermined target prices, you can execute your plan with confidence, not fear. This is the difference between an amateur and a professional. Okay, you're mentally prepared, and you have your watch list ready. The market starts to tumble, and one of your target prices is hit. How do you actually deploy your cash? This is where most people get it wrong. They see the dip, get excited, and throw all their available cash in at once. What happens if the market continues to fall another 20% the next day? They're out of ammo and now watching their new purchase fall, filled with regret. The solution to this is a strategy called dollar cost averaging into the dip. Instead of investing your entire lump sum at one price, you break it up into chunks. Let's say you have $5,000 set aside for buying opportunities. You could decide to invest $1,000 the first time the S&P 500 drops 5% from its high. If it falls another 5%, you invest another $1,000. If it falls into official correction territory, down 10%, you invest another $2,000. And if we enter a bear market, down 20%, you deploy your final $1,000. This systematic approach does two things. First, it drastically reduces your risk of putting all your money in at a temporary peak. Second, and just as importantly, it gives you a psychological victory. If the market keeps falling, you don't feel like you've failed. You feel like you're getting an even better deal on your next purchase. It turns the anxiety of a falling market into a structured process. You're not just hoping for the best, you're following a proven plan that manages risk and capitalizes on volatility. Now, let's talk about a more advanced, but incredibly powerful tactic for taking advantage of a dip, and that is portfolio rebalancing. This is a strategy that forces you to be disciplined and to sell high and buy low automatically. Here's how it works. Let us say you've decided on a target asset allocation for your portfolio, 60% in stocks and 40% in bonds. During a long bull market, your stocks have likely performed very well, and that allocation might have drifted to 70% stocks and 30% bonds. Your portfolio has become riskier than you intended. Then, a market dip hits. Stocks fall sharply, but bonds typically hold their value better or even go up. Now your allocation might be 55% stocks and 45% bonds. To rebalance, you would sell some of your bonds, which are now overweight in your portfolio, and use that money to buy more stocks, which are now underweight and on sale. Think about the elegance of this. You are literally taking profits from the assets that held up well and using them to buy the assets that are now cheaper. You are institutionalizing the buy low, sell high mantra. Most major brokerage platforms have tools that can help you do this automatically or show you exactly what to sell and buy to get back to your target allocation. It's a proactive, unemotional way to ensure you're always putting money to work where the best value is. Finally, we need to address the most critical part of this entire process: what not to do. There are two catastrophic mistakes that wipe out more investors during a dip than anything else. The first is using leverage, like buying on margin or trading options you don't fully understand, to try and amplify your gains. When you buy a stock with cash, if it goes to zero, you lose your initial investment. When you buy with borrowed money, you can lose more than you initially invested. In a volatile market, a quick move against you can trigger a margin call, forcing you to sell your other holdings at the worst possible time to cover your losses. It's a recipe for financial disaster. The second fatal mistake is selling your long-term investments in a panic to preserve cash. You are literally locking in a permanent loss and turning a paper loss into a real one. You are also guaranteeing that you will miss the eventual recovery, which often comes swiftly and unexpectedly. The biggest gains frequently occur in the early stages of a rebound. By selling at the bottom, you experience the full pain of the downturn but none of the pleasure of the recovery. Your number one job during a dip is to protect your capital, not by fleeing, but by being shrewd, patient, and disciplined with the strategies we've just outlined. Before we conclude, it is my absolute responsibility to provide a clear and serious disclaimer. This video is for educational and informational purposes only and is not financial advice. I am not a licensed financial advisor. All investments involve risk, including the possible loss of principal. The strategies discussed, including buying the dip, do not guarantee profits and can result in significant losses, especially in a prolonged bear market. You must conduct your own thorough research and consult with a qualified financial professional who understands your personal risk tolerance and financial situation before making any investment decisions. Never invest money you cannot afford to lose. Past performance is not indicative of future results. Your financial decisions are your sole responsibility.